Good afternoon, I'm Brigid Taylor and this is Currency Wars. Today I'm joined by Andre Cilliers, he's the director at TreasuryOne, and my friend Jan Sluis-Cremer, he's the foreign exchange and money market salesperson at RMB. But let's have a look at what's driving the currencies this week. The rands behaved surprisingly well amidst the positive local data and in spite of the increasing tensions that are in the Eurozone. The unit has traded between 12.15 and 12.25 over the past week, although it's a lot weaker now, and the cross rates between around a 20-cent range. Meanwhile, the South African June Purchasing Managers Index came in a lot stronger than expected, as did the May trade data. And the government finance figures are pointing to a smaller than expected budget deficit if this trend continues to hold. The country's government has also finally made progress in addressing Eskom's need for funding. However, this was done through a sale of its Vodacom stake to the PIC, raising close to 25 billion rand. Meanwhile, the Greek crisis continues to loom, and the failure of the country to repay the International Monetary Fund has pushed Greece into the glaring reality of what life will in fact look like outside of the Eurozone. If it means staying in the currency bloc, the majority of Greeks may be willing to vote against the very government that elected them 5 months ago. And this will stand against austerity in the referendum scheduled for Sunday. Creditors are insistent on pension reforms that would bring savings of as much as 1% of GDP by 2016, and immediate steps to eliminate early retirement benefits and allowances for lower pensions. Meanwhile, in the US, the upbeat June jobs data for employers in the private sector added 237,000 jobs. The country's factory activity measured by the Institute for Supply Management hit a 5-month high, and this has been a strong support for the dollar. The US economy and the Fed rate decisions still pose the biggest risk to rand weakness. Right, now that we know where we stand, we're going to have a look at the deeper issues that are driving the markets this week. Jan and Andre, welcome. Let's talk first of all just with regards to the sale of the Vodacom stake in terms of supporting our Eskom entity. Just give me a feel from your side. Do you think that's a good decision? What do you think it speaks to with regards to the NERSA debacle that we had last week?
I would have been very happy if I had confidence in Eskom. I'm very unhappy at this stage because it seems that we're selling our crown jewels, no more dividend flows from that side, and we're pouring the money into a bottomless pit. So that's a bit of a concern to me. As I say, if I had more confidence in Eskom to actually do something with the funding, produce electricity like they should, then I would have been happy with that. But at this stage, I doubt it.
So you're saying it's not a money issue, it's actually a fundamental issue around the management of Eskom?
I think so, yes.
Okay, Jan and you, what do you think in terms of that decision?
Yeah, look, you kind of got to agree with Andre. I mean, it is a tough call for government to have had to have made that to go and sell their stake in Vodacom. You know, they kind of ran out of options, so they're literally grasping at straws at the moment. And you know, for the country to move forward and the economy to start growing, and you know, all the good things, they need somehow to fix Eskom. And I suppose this is their one way of, you know, trying to, because they can't continue going back to you and I and adding more tariffs and more increases onto our cost of electricity. I mean, it is a massive big black hole at the moment, and it's just a bottomless pit, and it's you know, it's trying to catch a falling piano. I mean, it's almost impossible at this stage of the game.
Well, that's the thing. I mean, it almost feels like it's a plaster on something that is so much huger than what a plaster can cover. So the real question is, you know, the impact of Eskom in terms of our growth outlook. If we look at the South African growth, a large portion of that deterioration is coming from Eskom and looks as though it's going to continue for the while ahead, as well as the fact that we've got other push factors. So with regards to, you know, the underlying entity, I'm not going to harp on it. What do you think in terms of the bigger view? Do you think that this is just something to plug a hole, or do you think that there are plans in motion that potentially will take this to a position where we'll start to see some form of growth and some form of support out of Eskom?
I am going to give the government some credit. I think they realize the problem. So I think there is plans behind the scenes that we might not be aware of and that we don't see.
Okay.
Having said that, we're coming up for a monetary policy meeting mid of July. We're speaking of interest rates. Now, at this stage, everybody says we cannot increase interest rates because then that will dampen growth. Growth cannot be supported by monetary policy at this stage. Monetary policy should sort out other issues, and I think they will. I think we will see an interest rate increase. Growth has got to be facilitated through structural change, majorly from within the Eskom side. But as I say, I think there is steps behind that one.
Okay, so let's move on to the Eurozones. We've obviously all heard, and we're inundated with at the moment is news around Greece, whether or not, in fact, they're going to vote yes or no in this referendum on Sunday. They're faced with the harsh reality, and I mean, we've seen people standing and queuing. They can only draw 60 euros a day. Pensioners went to get their pension today, and a lot of them weren't even paid out. So there's glaring reality of life outside of the Eurozone. Do you think that this is a short-term issue in terms of Greece should in fact exit, and potentially if they get their own currency back, they can rebalance? Or do you think that the pain is going to be too great and they're going to remain in the Eurozone?
I actually think the pain will be too great if they move out of the Eurozone. You know, yes, it's short-term hardships at the moment. The fact of the reality is they can't afford to go back to Greek drachmas because inflation is going to almost spiral out of control. Their currency is not going to be worth much. And they literally will have a very big hole to try and dig themselves out of. And it's all, you'd like to think it's almost not even possible in the longer term because of the damage that'll be done by leaving the Eurozone and heading back to, back into Greek drachmas and, their own little economy.
And there are ways. I mean, they've spoken, the creditors have said things like, we need to increase the taxes on the very wealthy, those sub-islands where people have got their money housed. They need to pay less pensions. They need to extend the time for people to be able to claim on those pensions. These are realistic things. I mean, as South Africans, we don't even have half of those benefits, and they feel like it's a huge austerity. Do you think that these are things that will cripple that economy, or do you think it's just a change of culture in terms of actually funding that deficit that they find themselves in, Andre?
They find themselves in a deficit, but I want to mention something, and I was listening to a professor from a university in San Francisco who clearly mentions, if you think about it, no government actually ever repays their debts. It's all about being able to afford your debt. Now, there's only one way of able to afford your debt, and that's grow your economy.
Or have revenues.
Or have a revenue stream that can fund those expenses. I think what will happen, what we're going to see now is a few people with very short political careers. We're going to see a government of unity going back to the negotiating table after a yes vote in the referendum. They will go back with credibility because it's a unity government. Then we'll see a round of elections. But I think a month from now, we'll have more clarity and we'll have a Greek country that stays in the Eurozone.
It's quite interesting because I think that the lessons learned, it almost feels as though Merkel's the parent here and it's slapping the children on the wrist because they're misbehaving and having to really give tough love in order to show them that they are misbehaving. So let's look at, lastly, just in terms of non-farm payroll. So that ADP data came out yesterday very positively, obviously seeing that dollar strength. We've seen it in the rand. The rand's a lot weaker today again. Do you think non-farm payrolls comes out with a good number? And what do you think the upside trajectory? I'm going to make you give me some levels just now, so don't put them on the table now, but just talking about the risks around this non-farm payroll number.
Look, I'm kind of, after yesterday's ADP number, I'm kind of looking for a much better number today to print for non-farms. Consensus is around about 233,000. Last month was 280. I'd probably put a pitch in anywhere around 250, 260 this month. We saw that the fall off in the first quarter of the year where numbers weren't producing, but we kind of really back on track fairly quickly again.
And that trajectory continues.
And the trajectory continues. I think it's not only to look at how many new jobs have been created and the overall percentage. I think where we got to look at is wage inflation. Is that on the up? You can go and create all these new jobs, but wage inflation stays the same. It becomes the difficult position that the Fed to then go and raise rates. So we also need to look at that number. But I do think the trajectory is up, and you got to be long dollars. It's just there's no two ways about it.
So you've got this leading indicator in terms of your employment, because obviously as people get employed, they start to spend. So it's almost like that inflation is a lagging indicator. We're going to have another Fed committee coming up, but we've got, as you mentioned, our SARB. So the South African Reserve Bank, a lot of people feel like we're maybe potentially slightly behind the curve or waiting for the Fed to be preemptive around what the Fed decides. Do you think that's going to be too little too late, or do you think that South Africa is just in a completely different scenario and we're stuck between a rock and a hard place, Andre?
Our governor has said it before, and I think he will reiterate that in this next MPC meeting again, that is not being driven by what happens internationally. He's driven by what happens within this country and doing his job within this country.
Yeah.
I have a lot of respect for him. I think he'll stay to that, he'll stick to that, and he's going to place us in front of the curve by making a move in July.
Okay, that's a good call. So now that we know where we stand, we're going to pull out the big guns and have a look at the levels in the week ahead. Right, guys, this is it. I need some views. I know the cross rates are a little bit, dependent on what obviously comes out specifically on the euro with regards to the referendum. But Jan, I'm going to start with you. What is your view with regards to predominantly the rand? Is that going to be the main driver in terms of the cross rates? And just give us an idea of what we can expect.
Look, I think rand at the moment. I mean, we saw the rand strengthen nicely Monday and Tuesday, especially Tuesday. It was half year end. It was year end for a lot of companies. We had a lot of liquidation of perhaps some stale long dollar positions. And we saw that move down to the support level of the 12.12 area. Subsequently, then since yesterday, we've kind of seen it backtrack all the way back up. I think last night close above 12.19. Today, big level, close above 12.30. Look for a move back to 12.50 again next week, but very much data dependent later on this afternoon.
Yeah, non-farm payroll data.
With non-farm payroll data at 2.30, but certainly for me, dollar rand is buy on the dips. I think we are going higher again.
Okay, Andre, do you want to give us a view on any of the cross currencies?
I'm going to say 12.25, 12.55 on the rand. Euro rand, I'm going to call 13.50, 13.75, and on the pound, I'm going to call 19.05, 19.40.
So a lot weaker. The euro is
Yes.
the real area that's taking strain. So in conclusion, really, this week, Andre and Jan both expect to see the rand a lot weaker. We're looking at a base around that 12.25 level, potentially trading as high as 12.50. Obviously, that is data dependent, and the big number to watch is the non-farm payroll data this afternoon. On your cross rates, expect the euro to remain vulnerable within that 13.60, 13.75 sort of range, and your pound to remain above 19. So buy the dips on the pound, the euro, and the dollar if you're an importer. As an exporter, hang on to your socks because we've got upside potential. If you'd like to send any questions or comments, you're welcome to do so at CNBC Africa, #CurrencyWars410, or to myself at Brigid Taylor for your personal responses to the FX markets. Until next week, good luck in the trenches.
There's nothing.